Diversity, green, fair, inclusive, equitable, ethical, common good, sustainable, stakeholders, net zero governance. As the world finally wakes up to the communist agenda of the Great Reset, the tired buzzwords of the woke echo chamber are increasingly struggling to hide the wholesale scam that is ESG. But if the political narrative is crumbling by the day, the investment strategy backed up by it, however, remains alive and well. From brokers inorganically incentivizing you financially to invest in the ESG theme, to advisors force-feeding phony investment ethics that are not yours, to big money managers window dressing their funds to make them look like some ESG financial breakthrough, the investment case mostly relies on flashy marketing, but is rarely based on numbers. So today, we're going to break from this nonsense and investigate how well ESG factually performs as an investment, quantitatively and without any bias. Forget the buzzwords and the virtue signaling. It's high time to check whether their values actually bring you value. Lifting the veil on the highly politicized and subjective hot mess that is ESG requires to apply some scientific rigor to our study. To achieve that, our analysis will consist of two distinct quantitative assessments, namely passive and active investing. While passive investing will allow us to make a direct assessment of the intrinsic value of the ESG filtering and stock picking, in the case of active investing, we'll be using a neutral and systematized investment process in the form of a trading algorithm in order to get a good indication of how well alpha can be extracted from the ESG universe. Risk-adjusted performance will be normalized and compared every time. Starting with passive investing, in order to conduct our test, I picked 4 of the most iconic ESG-centric ETFs and proceeded with comparing them against the plain old S&P 500 index, each one since their respective inception. Namely State Street's SPDR Gender Diversity ETF, ticker SHE, BlackRock's iShares MSCI USA ESG Select ETF, ticker SUSA, Vanguard's ESG US Stock ETF, ticker ESGV, and again Vanguard's ESG International Stock ETF, ticker VSGX. As you can see in this table, the vastly scattered inception dates demand that 4 independent tests be realized. This lack of uniformity is welcome though, as it also happens to provide a more random and unbiased set of samples to cluster our performance comparisons over different stretches of bullish and bearish market regimes. And this is certainly preferable for the significance of our test. Every time, I compare the risk-adjusted total compounded annual growth rate, meaning net of fees, but including dividends. Normalizing for risk was achieved by using 3 different ratios with the industry standard Sharpe ratio, the beta to S&P 500, and of course, the MAR ratio, which compares the total annual return to the maximum drawdown. And for the sake of completeness, I also added their individual alpha to obtain another measure of outperformance, as well as their R-squared statistic in order to get a better idea of the tightness of the performance distribution around the S&P 500. Every time, all the comparative calculations were made since each ETF inception, since SPY is one of the oldest existing ETFs and is obviously older than every single one of its ESG counterparts. Here are the results. Starting with the State Street's SPDR Gender Diversity ETF, we know that with a number of stock components that is less than half that of SPY and a very recent inception date, the difference that the ESG stock picking makes is going to be very apparent. And as it turns out, the outcome is dismal for ESG. The ETF generates about 60% of the return while realizing slightly more risk. That ETF is therefore an inferior investment proposition than investing in the S&P 500 overall, and by a long shot. Moving on to BlackRock's iShares MSCI USA ESG Select ETF, ticker SUSA. Just as with the previous ETF, we're getting a number of stock constituents that is much lower than SPY, about a third in that case. But with an inception date starting 11 years earlier than the Gender Diversity ETF, we can expect the performance to be closer to that of the S&P 500, simply due to the law of large numbers having more time to smooth out randomness. Unsurprisingly, we can see that the investment performance is much closer indeed to that of the S&P 500, albeit still worse, but only by a whisker. As I said, randomness seems to be increasingly playing out here. Next on our list, Vanguard's ESG US Stock ETF. With 3 times the number of stocks, but only 14% of the tenure of the SPY tracker, this one provides us with a good indication of what is more influential in creating an investment wash, meaning what factor between components and tenure is the best performance randomizer. Clearly, we can tell by the results that the number of stock components has the most influence. Even then, despite the very recent history of the ETF that should have been beneficial to it due to the recent ESG hype, we can see no meaningful difference in risk-adjusted performance. In fact, this ESG ETF still appears to be a smidge worse off than the plain S&P 500 ETF, with a 5% lesser annualized return for roughly the same risk. And to finish, let's review the Vanguard's ESG International Stock ETF, which has over 10 times the number of S&P 500 components, yet the same very short inception date as Vanguard's US-centric ESG ETF. With a number of components that high, we would have expected to see the results come very close to the S&P 500 ETF, but that is not the case. The results are way worse, over 8 times worse off actually. With a whopping 0.91% annual return, this ETF is clearly suffering from its international allocation in markets that have vastly underperformed the US market recently, and most likely some heavily unfavorable FX conversion on top of that. So to summarize, the ESG passive investing proposition appears to be ridiculously underwhelming. At best, these dedicated ETFs barely manage to meet the performance of the S&P 500 over their respective lifespan, and in most cases, they severely underperform. Yet, this is not what mainstream so-called market intelligence and those big buck funds would have you believe. As you can see in this Bloomberg excerpt, cherry-picking the time span applying to the study makes for a very convenient way of shedding a partial yet favorable light onto the ESG narrative. Alternatively, a variation of misleading marketing techniques is used by BlackRock on their website. What they do here is pick the exact ETF with just the right inception date that happens to have returned more than the broad indices, even by a statistically insignificant margin. Unsurprisingly, no obvious mention of risk is made anywhere, since it is well known in the industry that retail investors equate performance with return alone and will therefore not be looking for any risk normalization. But as you can see, even this marginal outcome in favor of ESG is deemed acceptably sufficient by BlackRock to support the claim of potential future outperformance. This is quite evidently bogus due to the sampling artifact and their knowledge of those other funds that we reviewed and many others that we did not, that consistently underperformed the market or yield a totally random outcome. Mind you, for all of those out there who cry out loud for more regulation to save themselves from scams, this right here is fully compliant with current regulations. So go ahead, knock yourself out. Anyway, moving on to the active trading portion of our ESG assessment. Instead of the buy and hold strategies that we just compared, we're going to assess the alpha supposedly provided by ESG-centric stocks by isolating them in the totally neutral, impartial, and systematized environment of a trading algorithm. To achieve that, I ran one of my most active personal algorithms against the ESG-agnostic S&P 500 components on one hand, and against the components of the iShares MSCI USA ESG Select ETF on the other hand. The reason why I chose this ESG ETF specifically is because it offers the best blend of a narrow stock selection, long tenure, and a passive performance that's comparable to the S&P 500, even if it is inferior to it as we just saw it. One of the main advantages of this comparative test is that it provides a much longer time sample, since I am able to run this algorithm accurately as far back as 1988 instead of the 2005 inception year for the SUSA ETF. The algorithm also provides a very high sample of trades in the thousands, which makes the results very highly significant statistically speaking and makes the whole exercise as relevant as it gets. For all those reasons, we can be confident that this test will provide a fair ground in extracting the performance difference between plain and ESG-specific stocks within a sterile, consistent, and rule-based investment environment. Here are the results. First of all, we can observe that both equity curves are very stable and similar. Also, despite the widely different number of constituents, both the control system and the ESG system generate a similar number of trades, which again speaks for the statistical significance of the test itself. Now here's what is interesting though. Despite a higher compounded annual growth rate by about 10% in favor of the control system on the S&P 500, both systems show eerily similar risk metrics. So much so that it is quite impossible to draw a definitive answer as to which one is safer. So for all intents and purposes, both systems are equally safe or risky depending on where you want to take it from, with the control system on the S&P 500 keeping a slight long-term edge as far as return on investment. So the verdict is in, and it is very clear. First, passive index investing shows that ESG is generally a materially less performing buy and hold investment proposition than investing passively in the entire S&P 500. Second, active trading, on the other hand, is much closer to a draw. It is quite clear that randomness prevails here. But if we had to take sides, the active trading test proves that stock picking ESG stocks specifically does not provide any edge whatsoever in generating excess risk-adjusted return by way of mere stock picking, as is falsely claimed and advertised by mainstream finance. If anything, given an equal risk, ESG would actually generate a slightly lower return for that matter. So the bottom line is, the hyped up edge provided by ESG is a provable lie, and whenever it appears, it is only due to randomness or sampling bias. What we learned today is that with just about everything pushed by the woke agenda, a 5-minute factual investigation is enough to uncover the scam. It also should make you wonder about the integrity of those employees in the media or big investment firms such as BlackRock. In the best case scenario, this shows clear incompetence, but more likely than not, it is yet another case where willful ignorance and intellectual dishonesty are gladly embraced as long as following deceptive orders is legally covered by regulatory bodies and awards them that paycheck at the end of the month. I think it is time to remind everyone here that deceiving investors with blatantly bogus claims is still a crime, even if it is approved by regulators. What you are witnessing here is the pure expression of corporatism, where government and big corporations collude to leverage regulation in an attempt to push more intricate rules such as ESG in order to both make it harder to follow for smaller players, eradicate competition in the process, and consolidate their monopoly while promoting a supposed agenda of common good. There is nothing well-intentioned or even remotely capitalistic about ESG. ESG is the straight-up embodiment of communism through corporatism. Now, it would be all well and good if the exercise was mere woke propaganda. After all, you would have the freedom of choice to be stupid enough to believe it and pay for it through bad investments. The problem is when you start seeing ads and programs like this one, because you know that after the carrot comes the stick. And while it starts with economically incentivizing the average investor to buy into the communist narrative, we all know how the story ends after a while. It ends with applying negative incentives. This could take the form of higher commissions or even extra transaction fees and taxes on trades that would not be made on ESG stocks. The ultimate game could even be that the average investor could be deemed too incompetent to manage his own money in a so-called sustainable way and should therefore hand out any and all money management to big corporations such as BlackRock, who would be deemed the only reliable custodian for investing your estates in a compliant way. If we see far enough with the implications of ESG and we remove any politically correct euphemisms, we realize that what all of this is nothing but yet another government claim of ownership on your private property through big corporations. In straight terms, ESG is nothing but yet another expression of government-sponsored slavery. If you believe that I'm taking leaps here and doubting the logical thought process, I would suggest that you watch this in-depth video in its entirety, where I laid out a comprehensive course about what natural law and private property are, and how you can use this knowledge to understand and reclaim your sovereignty. Hardcore truths are laid out throughout, and it might hurt a lot of feelings, so do not be surprised for rage quitting on it before the end. Blame social programming for it, but that's what most people are going to do. In any case, today's video should have at the very least provided you with ample evidence that ESG makes for a poor investment case. There is a reason why finance and activism are two different notions, so if you really want to promote an idea, I would suggest that you make a straight up donation and leave your investments unaffected. It will be both more beneficial to your cause and financially savvy to do so, instead of buying into some ESG scam with some dubious societal impact and a less than average financial performance. You are warned, guys. I'll talk to you in the next video.